Well, the president's trying to seal the deal today on financial reforms this morning. He's speaking in New York, and the goal is to convince Wall Street CEOs and reluctant Republicans to get behind a Democratic bill that's working its way through the Senate right now. It's certainly no easy task, but we're going to try to break it down today with some great financial minds in Washington. Michael Greenberger, professor at University of Maryland School of Law and also former director of trading and markets at the Commodity Futures Trading Commission. Michael, thanks for being with us this morning.
You're welcome.
And we also have with us Jill Schlesinger here in New York, editor-at-large at CBSMoneyWatch.com. Great to see you as well, Jill. Michael, I want to just sort of break down into the three main pieces of this legislation right now that are perhaps controversial and that are things that both sides are going to go back and forth on. One is the regulation of derivatives, these complex financial instruments, or as Christine tells me, just call them bets on the future price of some asset. Also, the mechanisms in place to unwind these markets, these bad financial institutions without taking everybody down, sort of the too big to fail notion, and then also a Consumer Protection Bureau. So when we take a look at those things, Michael, would this bill have stopped the collapse we saw in 2008?
I definitely believe it would have stopped the collapse in 2008. As you've highlighted the three parts that are the focus of the bill, but right now the battleground is over derivatives. And as you mentioned in an earlier segment, the Goldman Sachs suit, which was essentially selling bets on whether the housing market would go up or whether it would go down, had nothing to do with the real economy, but billions and billions of dollars were bet. And then in the end, the people who lost the bet didn't have the capital to pay it off, and the taxpayer became the banker of last resort. This bill would put those bets on the public eye. They would be transparent. They would have to be backed by capital. You couldn't find out at the end. For example, AIG was $80 billion short on September 16th, 2008.
Right.
That would be prevented. So my view is the most important part of this bill is stopping the betting transactions that had nothing to do with the real economy and taking them off the table.
Okay. And I want to ask Jill, do you agree? You used to trade derivatives, right, back in the day?
Yeah, my first job on Wall Street. Well, I think the derivative reform is important, and I think that what we're really talking about is that derivatives in this light really don't have any social utility. In other words, there's no usefulness in our society, in the capitalist structure, and they are really just bets, as opposed to, let's say that, you know, you're buying oil futures because you're an airline and you need to hedge your exposure to rises or falls in the price of gas, right? So that's different. The concern I have about this bill is that it still does not deal with this too big to fail notion. So what they've done is they've said, okay, you know what too big to fail is? It's where we are right now. And that doesn't seem reasonable. These companies are so big and so interconnected. Even if we see what they're doing on various exchanges, it doesn't mean we can't have a bubble in an asset class. And even though we may have some way to wind them down, why are we letting them get so big in the first place? And I fear that that is something that will continue to plague the system.
So you think that the too big to fail aspect doesn't go far enough, Jill?
Absolutely. I think that they actually don't deal with the too big to fail notion. And there are also, my fear in the negotiation of this bill is that there's going to be a lot of exemptions and carve-outs. Let's watch for that, because you're going to see a lot of ways that people can skip through the big holes in this slice of cheese.
And Michael, that's what I want to ask you about as well. I mean, there are some who say, look, if you try to regulate these derivatives and tell, you know, certain banks they can't have certain financial institutions they can't have exposure to the consumer and to these risky bets, they're going to take the risky bets and not the consumer, because that's where the money is.
Well, actually, for example, yesterday in the Senate Ag Committee, they absolutely banned trading gaming transactions.
Right.
And I think that goes right to the Goldman case. As was said, the Goldman situation was one side was betting that housing prices would go up, the other side was betting housing prices would go down. The bettor on the upside lost, and there was no money there. The American taxpayer had to pay. Yes, I agree. These transactions have no social utility. They're going to be spun out of the big banks. It's going to take a risky attempted profit center and put it to the side.
Right.
I think that goes a long way to shrinking these banks so that they aren't too big to fail. And then we have the Volcker rule sitting on the sidelines, where proprietary trading, that is trading only for the bank's book and no one else, where they took big risks, that
Right.
would have to be sent out.
All right,
So
so-
I think we have a real chance here for good, helpful reform to save the American taxpayer and American jobs.
All right, so let me play devil's advocate here, Jill, before we go. What is the downside then? Because it seems like an easy target. Wall Street, lawyers, bankers, we need to get them under control. What is the downside of too much regulation in this instance? It could have unintended consequences that all of us at home don't really know about.
Well, I think that there are a couple of unintended consequences. One is that we end up getting a lot of rules with lots of exemptions, and there's no substantive change. One of the other problems, for example, let's look at the Consumer Financial Protection Agency. Sounds like a great idea. Who wouldn't want consumers to be protected?
Right.
Except that it doesn't really feel like it's independent. Are they really going to be rule makers? Are they going to live under the Fed? How is that going to work? So the problem is that we want smart regulation, and I know that governments haven't been exactly on the forefront of smart, but also I'm going to give you a little ray of hope. After the crash of '29 and the Depression, we had years where regulatory reform was enacted in 1933 and 1934 and 1940, and maybe our professor is right down in Washington. Maybe this is the beginning of a longer-term trend where we get smarter about regulatory reform.
All right, Jill Schlesinger, Michael Greenberger, great to talk to both of you this morning. Thanks.
Thank you.
Welcome.